David Burrows is here from Barometer, and we're talking today about North American large caps. We're going straight to the mailbox first for Ingrid. She writes in on Lululemon. She's looking for your opinion on it.
Sure. So, Ingrid, I think you have to look at this a couple of ways. First of all, from a sector standpoint, retail has been a big outperformer over the last 52 weeks, and recently has been coming under a little bit of pressure. Some of the higher-end, more luxury good retailers have had some issues. A couple of the jewelers in the U.S. have given some guidance going forward that doesn't look quite as rosy as it has been. Tiffany's would be one of them. So when Lulu came with their earnings, while the earnings were quite good, their forward-looking comments were less rosy. And not to say that they were poor, they just were less positive, which is fine. But when the stock is trading at 40 times earnings, in a market that's skittish, in a sector where you're seeing a little bit of money take profits, you know it's problematic. So I would say in the short run, probably Lulu's stock has some work to do. I would be cautious. I think that maybe there's some downside here, certainly to the $60 level anyway.
That's about that 200-day moving average.
That's right. And, a lot is going to depend on whether this market can find a footing, as it has over the last couple of days. But I think in the short run, you're going to see some profit taking in Lulu, because that multiple is a very expensive multiple.
Yeah, I pulled up the relative strength index, and the RSI shows that it's the herd mentality's pushed this into oversold territory. But over the last year, it rarely spends a lot of time in oversold territory.
It does, and I think that we just have to recognize the kind of market that we're in right now. And in the kind of market where people are somewhat concerned about the longevity of the recovery, people have less tolerance for missteps.
All right.
And so risk in the short run.
Ingrid, thank you for that. To Jacob now in Toronto on the local line. Hi, Jacob. Thanks for holding.
Hi. Thanks for having me on. I was just wondering what your opinion was on Encana and the future of natural gas. I'll just hang up and listen. Thank you.
So we'll tie the two together, but we'll look at different date ranges. I would say over the long period of time, the future for natural gas is quite positive, because, North America is going to work its way towards some kind of self-sufficiency, which is positive. In the short run, pricing for natural gas is very weak because there's so much new production that's come on along the way. In Encana's case, the stock's been trading sideways since September in a few dollar range, so it's been trying to base out. But I think that we're going to need to see a little bit stronger economy and a little bit stronger pricing before you see Encana really have any significant lift whatsoever.
Yeah, the street figures already. It's overvalued, not just fully valued, but overvalued.
Well, some of the risks are, as we go forward for a lot of these energy producers, is their hedges start to run off. And they wind up having to actually sell gas at current prices, and that could have a negative impact. So Encana is a great company. It's just they're in the wrong sector right now, and probably it's going to be tough for a little bit yet.
All right, Jacob, thanks for that. From Toronto now to Lisa on the local line as well. Thank you for holding, Lisa.
Oh, hi there.
Hi.
Thanks for taking my call.
You bet.
I wanted to ask you about Kraft, and is this a good time to get into it, and do you like this stock, or is there a better one? I'm looking for something, a good dividend player in the U.S.
Right.
Thanks.
Lisa, Kraft is a company that we own in our equity portfolios. Now, in full disclosure, we've been quite cautious in our equity portfolios over the last 2.5 months. And one of the areas, though, that has been performing really well are consumer staples. So we really like the consumer staples sector, specifically because they have really defensible cash flows, and many of them have dividend yields. Kraft is interesting because it has all of those attributes, but there are also potential catalysts coming at investors over the next while. There's a likelihood that they will split Kraft into two separate pieces. One, their global snack food business, which is a high-growth business, and the other, their grocery business, which is a little bit more boring, but will be a dividend holding. So I think that there's a catalyst to unlock some value here. It's in the right sector. It's one that doesn't have a lot of risk. I'm very comfortable owning the stock and buying it here.
3% dividend yields, 29 cents, plus the street believes there could be at least a 10% upside in just the stock itself over the next 12 months.
Yeah, we're very positive. Obviously, there's market risk, but I think that this is one you can own.
In the event it does split into those two divisions, would you, if you were in Lisa's shoes, knowing that you don't know her own personal situation, but would you continue to own both of them, or would you stick with one over the other?
Well, they're really going to be quite different. Obviously, for some of the very big global U.S.-branded companies, global growth opportunity is there from the growth side, and that's what they're trying to get at by splitting these two pieces apart. Having said that, there's tremendous demand for stable cash flow generating assets that'll pay a stable and growing growing dividend, which you'll see in the grocery business. So depending on what you're looking for, I like them both. But I would say if you're a more conservative investor, probably the dividend payer will be good, but you want to own it now through the split, because then you see some value created along the way.
All right, Lisa, there you go. Thank you for that. We're taking a quick break. David Burrows is our guest. He's the president of Barometer Capital Management. We're talking North American large caps, and the lines are free at 1-855-326-6266.